Hi, everyone. Let's take a look at the fourth quarter results and what some of the indicators might be saying are ahead for our portfolios as we head into 2026. Across the board, most indexes and most investments were up, other than real estate had a little bit of a pullback during the fourth quarter. Fixed income and yield curves are finally more normal than they have been in a long time. We are out of the inverted yield curve environment that we've been living in for the past several years. So the US and global markets around the world all have more of a normal shaped yield curve, which is good for the fixed income or bond side of the market. Now, the Federal Reserve has been lowering interest rates, and one thing that has been affected by that is the yield on money market funds. And so, for those of you that have heavy allocations in cash or money market funds, know that those yields have come down. They're currently right around 3.5%. Now, there are some alternatives that do have a slight bit of risk to them where we can squeeze out some more yield. This is an example of one. This is a iCash, ICSH is a very stable type of a short-term bond fund that does have a higher yield, currently just over 4% these days. If you are interested, please let me know and we can talk further about your own cash situation. Now, stock market returns have been good, but that also means that valuations are quite high still. This is a chart that we looked at last quarter as well. So valuations are measured by something called a PE ratio. So what is the share price? How many times is the share price to earnings? Currently, share prices are about 22 times what the earnings are. That is abnormally high. Average is about 17 times earnings. And so what does that mean for potential returns going forward? At least for the next 12 months, probably doesn't indicate anything. What you see on the left side, the orange diamond is where we are today, and the gray diamonds are historically where the market has returned uh, when we had valuations similar to today. So it could be losses, could be gains. There's really no correlation there, or at least over the next 12 months. A little bit longer term, 5 years looking forward, we're probably going to see some muted returns just because we are at some high valuations today, at least according to this chart. Now, that could change in one of two ways. And so, again, it's price to earnings ratio. So, one of two things will likely happen in the future. Either the share prices will come down, i.e., a correction, the prices will correct to what the earnings are, or the earnings will come up. And that's really more of what we're expecting. And so what you see, the bar chart on the left side, 2026, 2027, we are expecting that corporate earnings are going to continue to increase. In 2025, they're about 11.5%. Um, Forecasts here are for about 15% over the next 2 years. So that could justify those high valuations and those high prices that we see in the stock market today, assuming that earnings catch up to the stock prices. Now, part of that's going to depend on the economy, and in this case, measuring it by GDP, gross domestic product. And so this chart hasn't been updated yet. Some of this data comes from the federal government. As you may remember, the federal government was shut down, and so we're still playing catch up here, waiting for some of those government numbers. But this is as of the third quarter of last year. And you notice a big part of GDP growth is that lighter blue color consumption. It's about 68% of GDP is made up by the consumer. And so we need to look at how is the consumer doing today? And that's what this graph is looking at. We did look at this one at last quarter as well. And the part of the graph that I'm really focused on is the household debt service ratio. And so today, about 11.6% of household disposable personal income is being used to service household debt. And so that's still a manageable amount, at least historically speaking, for the consumer. So from that perspective, the consumer seems to be in pretty good shape. We do need to keep an eye on some of the delinquencies that we have. So student loans, 14% of student loans, federal student loans, are currently at least 30 days behind in payments. I think that that will probably correct itself. We've had a lot of turmoil and change going on in the student loan world and a lot of confusion. So that might come back down once people figure out what's going on with their student loans. We'll have to keep an eye on credit card debt, mortgages, auto loans as well. Those are at a little bit elevated levels at this time. Now, what does this mean for the stock market? Interestingly enough, there is an inverse relationship between the consumer confidence index and the returns of stocks. And so the worse that consumers feel, or the lower that consumer confidence is, that tends to be a good sign for the stock market. And so all of these blue dots down here, this is the kind of the low measurements of consumer confidence. And the black line represents the stock market returns during those times. So again, this inverse relationship, the worse that consumers feel, maybe the better the news is for stocks. And so we today, December 2025, we are at some lower levels there. That could be positive for the market going forward. Now we are also at all-time highs, given depending on which day you're looking at the market. But it's one of the things that I hear is I want to wait for a pullback. I want to wait for a better entry point in order to get into the market. It's too rich. It's too high for me at this point. And really, when people tell me that, we have to look at what does the data actually say. And so the green graphs that you see on here, these are the investing at those all-time highs. And so it's okay to put money to work, even though the stock market may be making new highs. Oftentimes, those new highs become the new floor for the market. So as it creates those new highs, that becomes a barrier, that the market will stand on it and grow from there. So in most cases, investing at a new high versus compared to any other day in the market, you do in many cases, just as well, if not better, investing in those new high days. And so with that, if you do have questions, I'll be happy to meet with you regarding your own portfolio. And until I see you next time, please take care. Bye-bye, everyone.